Personally, I want to pay as little tax as possible, so as many people I know of. Today in this video, I just want to outline top 7 general tax tips to pay less tax as an individual. Looking at the fact that we are actually nearing tax year end, 1 or 2 of these tips can actually help you pay less tax for your 2022 year of assessment. Hi, my name is Molen Mkuze. I'm the Managing Director of Brendmo Accountants as well as Anchor Point Advisory Services. We are tax practitioners as well as accountants for business growth. Simply because we partner with businesses, we actually help them achieve their financial strength through the top line growth as well as the increase in their bottom line. The tips that I'll cover in this video are possible recommendations and may not be applicable to your individual tax situation. Should you want to know which one of those tips apply to you, you are welcome to contact our tax division at clients@brendmo.co.za and the team will gladly guide you accordingly. Okay, let's dive into the 7 tips to pay less tax. Tip number 1, open up a tax-free savings account. What is it? Can be your question right now. A tax-free savings account is offered by financial institutions that invest your money in a combination of financial products such as unit trusts, bank savings accounts, fixed deposits, bonds, etc. and etc. Someone might ask then, what is the major difference since I normally have a bank account savings account anyway? The major difference between this one and the other investments or other savings accounts is that all returns, that is the interest, the dividends, the capital gains earned from these tax-free savings will be tax-free. Like what the name suggests, it's a tax-free investment. What it simply means is you are not liable to pay tax on the growth of your investment. If you decide to withdraw from your account, there is no tax there on the interest. Isn't that awesome? Of course, there are a number of things you need to bear in mind. Firstly, this type of savings has an annual and a lifetime contribution limit set by SARS. The annual contribution limit is actually at 36,000 rands per year, as well as the lifetime limit of 500,000 for the lifetime. This simply means that once you have reached your lifetime contribution limit of 500,000 rands, no further investment in the tax-free savings account will be allowed for you. The good thing is there is no limit on a number of accounts you can open for your tax-free savings, meaning you can spread across your savings in as many tax-free savings accounts as you wish, provided you don't invest more than 36,000 in total for that particular tax year. Remember, tax year end for individual according to SARS runs from March to February. You might be wondering, what if this year I save less than 36,000? That is, I managed to only save 20,000 rands. Will I be able to carry over the difference of 16,000 and save it in the next year should money permits? The simple answer is, unfortunately, the annual limitation cannot be carried over to the next year, which means that you simply forfeit any unused amount for a particular year. In this case, if you save 20,000, you forfeit the 16,000 that you didn't use, as you are given a new annual limit each and every year to invest in a tax-free savings account. Contributing to a tax-free savings account has great benefits. One of the biggest benefit for me is that your growth or your earnings on the initial investments are exempt from tax should you decide to withdraw your saving later on. You are also able to reinvest or capitalize your returns, and they don't count towards your annual or your lifetime contribution limit either. Another benefit is unlimited withdrawals. You are free to withdraw from your tax savings account at any time you wish. However, there are conditions that you need to be aware of. For example, any replacement investment amount is treated as a new contribution and will therefore count towards your annual or your lifetime limits. Tip number 2 contributes towards a retirement fund. Unlike the tax-free savings, contribution to a retirement fund are tax deductible. The contributions are tax deductible up to a limit of 27.5% of the greater of your taxable income or your remuneration to a maximum of 350,000 per year. Everything apparently have limits in life, so as in tax as well. Okay, what do I mean? The taxable income, for example, in this case, let's say it's 500,000 and your remuneration is 400,000. The contribution deductible limit will be calculated on the 27.5% of the 500,000. This simply means that you or your employer contribute up to 137,500. All of it will be tax deductible. This limit applies to the total contribution you make to pension, provident, or retirement annuity fund during the year. The tax deduction will always be limited to the actual contribution you made. Normally, your pension and your provident fund contributions are usually structured via your employer. You will see this on your monthly payslips, but you can top up your retirement savings yourself by actually contributing to a retirement annuity fund. With a retirement annuity fund, you can contribute more to your retirement annuity, but after you have reached the limit I spoke about, your contributions are rolled forward to and automatically are deductible in the future years. This is a greater way to save for your future whilst also reducing your annual tax bill. Tip number 3, donate to a SARS-registered public benefit organization. A public benefit organization, PBO as it is often called, is a non-profit organization which has a special approval by SARS to not pay tax in South Africa on the donations it receives. The organization is most likely involved with charitable work, for example, poverty alleviation, health care services, education, housing, or child-related issues, services, or even religious services. Your contribution to a registered PBOs are tax deductible up to a limit of 10% of your taxable income, another limit. Any donations exceeding this limit is actually carried forward and can be claimed as a deduction in the following tax year. You will only be eligible to claim the tax deduction in your tax return if you have a Section 18A tax certificate. This is very important from that PBO. Please make sure that the PBO you are donating to is an approved one by SARS. Do you know that you can actually kill 2 birds with 1 stone? That is, donate for a good cause while reducing your tax bill at the same time. Tip number 4, join a medical aid scheme. If you contributed to a medical aid scheme this tax year, which is the 2022 year, you will receive a fixed monthly tax credit of 332 rands for you as the primary member, a further 332 for your first dependent, and 224 for any additional dependents that you have. SARS calls this rebate the medical scheme fees tax credit. It's actually a flat rate per month, regardless of your taxable income. It's very important to know that it's a direct reduction of your tax liability and does not result in a tax refund. Let's look at this practically. If Romeo pays medical aid for himself, his wife, and his 2 children, his tax credit for the 2022 year will be calculated as follows: 332 for Romeo, 332 for his wife, 222 for his 2 kids, a total of 1,112 would therefore decrease his tax liability per month and 13,334 for the whole year. Medical tax credits will not result in a refund, meaning if your medical tax credit is greater than your actual tax liability, then your tax liability will be nil and you will not receive a tax refund. This means that in this example, if Romeo's actual tax liability for the year is 10,000, it will be reduced by the tax credit of 13,344 to arrive at a nil due to SARS. He will not receive the difference of 3,344 as a tax refund. Okay, having spoken about tax-free savings, retirement contribution, PBO donations, as well as medical aid contributions, let's move on to tip number 5. Tip number 5, always keep a logbook if you receive a travel allowance. A travel allowance is a taxable fringe benefit, which means it will be included in your taxable income and you will be taxed on it. In most cases, 80% of the travel allowance is included for tax purposes. The assumption is that you drive or you travel 80% for personal and 20% for business. If, however, you keep a logbook to record all your business mileage, you can claim a travel deduction against it, which could reduce your tax owed to SARS. Please note, you can only claim a travel deduction if your travel allowance appears next to a source code 3701 or 3702 on your IRP 5. I know many tracker companies record your car trips. You can make use of that to generate your logbook for your traveling records. For an example of an acceptable logbook, click on the link below for a free download, or even contact us. We'll gladly share that with you. Tip number 6. This tip is for commission earner. You can claim commission-related expenses if you are a commission earner. If you are a commission earner, you will usually have commission income. This will be usually coded to your source code 3606 on your IRP 5. Please note, if your commission income, that is the income next to the source code that I spoke about, 3606, make up more than 50% of your total remuneration, that is the income next to source code 3699, your total remuneration, then SARS will allow you to deduct all commission-related expenses against your commission income. These are all expenses you incurred in order for you to earn your commission. Examples of such expenses could be your telephone expense, your stationery, your employee costs should you have someone who is helping you to do your work, or any other expenses that you incurred. Remember also to keep a logbook to claim your business travel trips. Last but not least, tip number 7. This tip is applicable to non-salary income earners. If you are a self-employed, that is an independent contractor, you are a freelancer, or you're a sole proprietor, or you actually own properties, well, SARS allows you to deduct all your business-related expenses against that business income. These are all expenses you incurred in order to earn that particular income. Examples of such expenses are also your telephone, your stationery, your interest on your bond should you be letting out that property and you are earning rental. I suggest you keep all records and the invoices of expenses together with the related invoice or statements so that you can take advantage of this deduction in order to pay less tax. Okay, just to sum up what we have covered through, though not necessarily exhaustive, we have covered 7 basic tips to pay less tax in South Africa. Tip number 1, make use of tax-free savings. Tip number 2, contribute to RA. Tip number 3, donate to your PBO. Tip number 4, contribute to medical aid. Tip number 5, keep a logbook. Number 6, if you're a commission earner, keep record of all your expenses. Number 7, you can actually claim your business expenses if you are a non-salary earner. That's it for today, folks. I hope you have found the content in this video helpful. If you did, hit the like button, subscribe to this channel, and remember to share this video. Thank you.